Welcome to Market Buzz by Reliance Smart Money. I am Sridhar Rangarajan, and today we will be speaking about a very popular and a favorite amongst a lot of investors in the fixed income category, tax-free bonds. Within tax-free bonds, we'll be looking at who are the issuers, what credit rating does it enjoy, what are its advantages, broadly disadvantages, and finally, who is it suited for. Tax-free bonds are those bonds whose interest earned in the hands of the investors are tax-free. Under a special act of the Parliament and under Income Tax Act 1961 Section 10, these interest or coupon which the investor earns under whatever frequency that it may be for the year is tax-free. The issuers of these tax-free bonds are either the government itself or government institutions like major PSUs. For example, IRFC, NHAI, NABARD, PFC, all these have issued tax-free bonds in the past. The credit rating of tax-free bonds is at the highest, given that they are either backed directly by the government or through a quasi-government agency. And they enjoy a rating of AAA, which is the highest in the bond category. The interest payment frequency typically for all tax-free bonds is annual in nature, and they are paid out to the individual investor. The biggest disadvantage of holding tax-free bonds is their long tenure. Tax-free bonds are long dated, which effectively means that they are either issued for a period of 10, 15 or 25 years. That is a long tenure. Tax-free bonds are also listed on the exchanges, which means there is a secondary market available for sale or purchase. However, a note of caution should be added that the liquidity may not be as high as its peers like debt mutual funds. Hence, liquidity risk is one of the key risks which an investor has to bear while investing in a tax-free bond. Tax-free bond appeals to the high net worth individual segment the most. Post 2016, there have been no issuances of any tax-free bonds. Hence, whatever tax-free bonds available for us to invest today are in the secondary market. And typically, the lot sizes over there are for 10 lakhs and above. Hence, the appeal and the outreach that these tax-free bonds offer are to the high net worth individual segment only. As I mentioned, that these tax-free bonds are available in the secondary market, which means that they are listed. But a note of caution is to be added that this secondary market transaction is not too vibrant and definitely not too liquid, which means there has to be an intermediary to identify a buyer for any sale to be done. Why do tax-free bonds sell? This is an important question. The tax-free bond segment offers a yield which is not currently available, and it is pretty attractive. The yield offered by various tax-free bonds available in the market today range from 5.25 to 5.75 or almost as high as 5.95%. This post-tax yield is very attractive in comparison to a plain vanilla bank FD. In fact, it is almost as high as 200 to 300 basis points higher than a post-tax yield offered by any other instrument of a similar nature. Needless to add that residual maturity of a tax-free bond would determine what is the yield that it offers in the market today. It means that if the residual maturity of a tax-free bond is greater than 10 years, the yield offered would be slightly better than a bond which is due for maturity at a shorter tenure.